Your employer is offering you free money right now. Not a raise, not a bonus, not a promotion you have to earn. Free money, just sitting there, waiting for you to claim it. And most people never do. Here's a number that should make you put your phone down and pay attention. The average employee who doesn't take full advantage of their employer's 401k match is leaving $1,336 on the table every single year. That's over $13,000 in a decade. Gone, just because nobody explained how it works. Today that changes. In this video, I'm going to explain exactly what a 401k is, how it works, how to set one up, and, most importantly, the one move you can make in the next 48 hours that could add hundreds of thousands of dollars to your retirement without putting in a single extra dollar of your own money. I'm going to cover what a 401k actually is and why it exists, the difference between a traditional and a Roth 401k, the employer match, which is genuinely free money most people ignore, contribution limits and how to think about them, the 3 most common mistakes people make, and exactly what to do today to get started. There is one thing I'm saving for later, something about the tax treatment of a 401k that most people get completely backwards. It's the reason some people choose the wrong type and cost themselves tens of thousands of dollars over a career. I'll get to that in just a few minutes. Let's go. Let me start with the most basic question, because financial education has a habit of skipping it. What is a 401k? A 401k is a retirement savings account that your employer offers you. You put money into it from your paycheck before you ever touch it. And that money gets invested in the stock market, grows over decades, and eventually becomes your retirement fund. The name 401k comes from Section 401k of the U.S. Tax Code, genuinely one of the least exciting names in financial history. But what it does is actually remarkable. Here's the analogy I want you to hold on to for this whole video. Think of a 401k like a special container, not the investments inside it, the container itself. You can put money into this container and the government says, "We'll give you tax advantages for doing that." The money inside grows. You don't pay tax on the growth every year. And depending on which type of 401k you choose, you either save on taxes now or save on taxes later. The container is the 401k. The investments inside are things like index funds and mutual funds, which you get to choose from a menu your employer provides. So when someone says, "I have a 401k," they're really saying, "I have this special tax-advantaged container, and I've put investments inside it." That's it. That's the whole concept. Everything else is just detail on top of that. Now, only about 56% of American workers have access to a 401k through their employer. If you have access to one and you're not using it, you're genuinely leaving one of the best financial tools ever created completely untouched. Quick recap. A 401k is a tax-advantaged retirement savings container offered by your employer. You contribute from your paycheck before you can spend it. It gets invested and grows over time. The tax advantages are the reason it's so powerful. Now let me tell you about the 2 types, because this is where people make expensive mistakes. Most employers offer 2 versions of the 401k, traditional and Roth, and the difference between them comes down to one simple question. Do you want to pay tax now or pay tax later? Traditional 401k, you contribute pre-tax dollars, meaning the money comes out of your paycheck before income tax is calculated. So if you earn $60,000 and contribute $6,000 to your traditional 401k, you only pay income tax on $54,000. You get a tax break right now today, but when you withdraw the money in retirement, you pay income tax on it then. Roth 401k, you contribute after-tax dollars, meaning you've already paid income tax on this money. No tax break today. But when you withdraw the money in retirement, including all the growth, it's completely tax-free. Here's the way I think about it. The traditional 401k is like getting a discount on a meal today but paying full price when you eat it later. The Roth 401k is like paying full price for the ingredients today, but the meal itself, all that growth over 30 years, cost you absolutely nothing when you finally sit down to enjoy it. Now, this is the thing I teased earlier, the thing people get backwards. Most young people, most beginners, default to the traditional 401k because the immediate tax saving feels good. But if you're early in your career, if you're in your 20s or early 30s, you are almost certainly in a lower tax bracket now than you will be in retirement, which means you should almost always choose the Roth 401k. Pay a lower tax rate now. Let it grow tax-free for 30 years. Pay zero tax on the withdrawal. The difference over a 30-year career can be genuinely hundreds of thousands of dollars simply from choosing the right container. If your employer only offers traditional, that's fine. Use it. If they offer both and you're early in your career, the Roth 401k is almost always the better choice. That is the expensive mistake people make, and now you won't make it. Quick recap. Traditional 401k saves you tax now, you pay later. Roth 401k pays tax now, everything grows and withdraws tax-free. Early career equals Roth in most cases. This is the part of the video I most want you to pay attention to. The employer match is the closest thing to free money that exists in personal finance. I do not use that phrase lightly. Here's how it works. Most employers who offer a 401k will also offer to match your contributions up to a certain percentage. A common structure is something like, we'll match 100% of your contributions up to 3% of your salary. Let's make that concrete. You earn $50,000 a year. Your employer matches 100% up to 3%. If you contribute $1,500 a year, 3% of your salary. Your employer puts in another $1,500. You just turned $1,500 into $3,000. Instantly. A 100% return on your money before it's been invested for a single day. This is not complicated. Your employer is giving you extra compensation that only exists if you contribute enough to unlock it. Not contributing enough to get the full match is the single most expensive financial mistake most people make. You are literally declining free money your employer has already allocated for you. The very first thing you should do when thinking about your 401k is find out what your employer's match is, then contribute at least enough to get every single dollar of it. That is step one. Before anything else. Some employers have a vesting schedule, meaning you have to stay at the company for a certain number of years before the matched money is fully yours. Always check this. It affects whether it makes sense to stay or leave. Quick recap. Employer match is literally free money added to your retirement savings. Always contribute at least enough to get the full match. Nothing else in personal finance gives you a 100% instant return. The IRS sets limits on how much you can put into a 401k each year. For 2025, the limit is $23,500 per year if you're under 50. If you're 50 or older, you can contribute up to $31,000 with what's called a catch-up contribution. Those numbers might feel enormous if you're just starting out, and that's fine. You don't have to contribute the maximum. The important principle here is not the number, it's the habit. Starting with 3% of your salary and increasing by 1% every year is a strategy that feels painless but compounds dramatically. A 1% increase on a $50,000 salary is $500 more per year. You'll barely notice it in your paycheck. But over 20 years, that habit of gradual increases can add an additional $80,000 to $100,000 to your retirement savings. The objection I always hear here is, I can't afford to contribute anything right now, and I want to address that directly. Starting with 1% of your salary is better than starting with zero. On a $50,000 salary, that's $42 a month, $10 a week. Most people spend more than that on things they can't name by Tuesday. The math of compound interest is so powerful at the beginning of a career that starting with almost nothing today genuinely beats starting with something significant in 5 years. $1 invested at $25 in a tax-advantaged account, growing at 10% per year, becomes $21 by 65. That same dollar invested at $35 becomes only $7. The cost of waiting is not theoretical, it is mathematically enormous. Quick recap. Maximum contribution is $23,500 in 2025. Start with whatever you can, even 1%. Increase by 1% every year. The habit matters more than the amount at the beginning. I want to cover the 3 most common 401k mistakes because avoiding them is worth more than most investment strategies. Mistake 1. Not contributing enough to get the full employer match. We covered this, but it bears repeating. If your employer matches 3% and you're only contributing 2%, you are leaving money on the table every single paycheck. This is the first thing to fix. Mistake 2. Not choosing your investments. Many people open a 401k, start contributing, and never realize they have to actually choose where the money is invested. If you don't make a selection, most plans default to a money market fund or a target date fund. The target date fund is often fine. It automatically adjusts your asset allocation as you get older. But just be aware, contributing is not the same as investing. Log into your 401k portal and make sure you've actually selected your investments. Mistake 3. Withdrawing early. Life happens. Sometimes people leave a job and decide to cash out their 401k rather than rolling it over to a new account. This is one of the most expensive decisions in personal finance. You pay income tax on the withdrawal, plus a 10% early withdrawal penalty. On a $20,000 balance, you could lose $6,000 to $8,000 in a single transaction. If you leave a job, roll your 401k into an IRA or into your new employer's plan. Never cash it out. Those 3 mistakes, missing the match, not investing, and withdrawing early, are the 3 holes in the bucket. Plug them and your 401k works the way it was designed to. Here is your exact action plan. No theory, just steps. Step 1. Log into your employer's HR portal or ask HR directly, do we have a 401k and what is the employer match? Step 2. If you have access and aren't enrolled, enroll today. Most plans take 10 to 20 minutes to set up online. Step 3. Set your contribution to at least the match percentage. Whatever percentage your employer matches, that is your minimum starting contribution. Step 4. Choose your investments. If you're overwhelmed by the options, choose the target date fund closest to your expected retirement year. Something like Target Date 2055 Fund, if you plan to retire around 2055. It handles everything automatically. Step 5. Set a calendar reminder for your next salary review to increase your contribution by 1%. That's the whole habit system. Review, increase, forget about it. That is 5 steps. Most of them take minutes. And the financial impact over a 30 to 40-year career is measured in the hundreds of thousands of dollars. A 401k is not complicated. It's a tax-advantaged container your employer offers you. The employer matches free money you should never leave unclaimed. The Roth version is almost always better if you're early in your career. Your investments need to be chosen. They don't choose themselves. And never ever cash it out early. The reason most people don't take full advantage of their 401k isn't because they can't afford to. It's because nobody sat them down and explained it plainly. That's what MoneyMastered is here to do, every single week. If this video explained something that's been confusing for a while, please subscribe. I know every channel says that. But here's why it actually matters for you specifically. Everything on MoneyMastered builds on itself. The compound interest video, the index fund video, the passive income series, they all connect. If you subscribe now, the next video drops straight into your feed and the whole picture starts to come together. Personal finance isn't one concept, it's a system. And we're building that system together, one video at a time. Hit subscribe, hit the bell, and share this video with one person who has a 401k they've never looked at. You might genuinely change their financial life. Next week, we are going deep on compound interest, the actual mathematics of why starting early beats investing more, and the specific number that will make you want to open an app today rather than next year. I'll leave links in the description below for the platforms I'd recommend for getting started. All free to open, all beginner friendly, all the ones I'd recommend to a close friend. See you next Tuesday.